You are a private doctor. Should you contribute more to EPF or buy more insurance? Hi, this is Limran N Live, the channel that talks about all matters around your insurance needs, protecting your money and your family's future. So like us and subscribe us today. The golden question for all of the private doctors out there: should I contribute the full sum of contribution to EPF according to the law, which is 12 plus 11%, it's a total of 23% of my income into EPF? Or should I put more money into insurance for my own coverage and family protection with returns? If you watch this video, I guarantee you that you will learn something today and it will impact your life in the future. The debate over EPF and insurance: should I put more in which account? Now, as a private medical doctor, your income derives from the actual work you perform. In the private hospital setting, it will be your surgeon fees, your consultant fees. And in the private clinic settings, it will be your consultant fees, some surgical fees, and most often your clinic operation profits that includes medication and medical services. Private hospital doctors must declare their income in full sum as what the hospital pays you. But yet, most of them do not pay full percentage of EPF. Why? Because some doctors told me it is not worth the investment. Because EPF interest is too low and they can do better with their money investing somewhere else, like the stock market, properties, and so on. So let's have a look at the historical interest of EPF for the last 30 years. It is 6.26 annually, but recently it has dropped to 6.17. So last year, EPF declared a yield of 4.5%, one of the lowest interest rate in 40 years. So what does EPF really do for us? EPF provides us a safe haven to save up for our retirement, which is crucial for most of the population who lack the ability to save up. But for the elite group of our society, EPF seems not too attractive for the appetite. What are the pros and cons putting your money into EPF? Let's look at the pros. Number one is a safe haven. There's no risk. Stable interest rate from 5.5% to 6.5%. It is somehow guaranteed by the government. The restriction makes sure that you have some money to retire with. And the restriction can be a good thing sometimes. So what are the cons of EPF? It is a very rigid withdrawal system. You have to be very sick or disabled to get your 30% on account B. But most of us withdraw account B for house loan lah, COVID once in lah, and so forth and so on. So not much is left when you're really sick, right? And the other thing, you can only withdraw when you're 55 or when you die early, which didn't really help too much when you really need the money to survive. Number three is whatever that you put in, you get. That's all. It's like a bank account. You do not get anything extra except for a little bit more of interest. Number four, there's no transparency in managing the money. You cannot go and tell EPF that I want to invest in this sector, in this country, and no. So sorry to tell you, they will manage it for you. So I would suggest that we still need to put money into EPF. Not that we totally do not contribute. I contribute to EPF because I get a tax rebate for contributing it, 12% of my income from my company tax. I force myself to save a little here and there. Better to have a small safe pot than to risk it all, right? And I only save the minimum required of me, meaning not the whole 23% of my total income, but only on what I declared on my salary. So there is a better way to contribute your 23% income to savings and yet get a whole lot more benefit out of it. Yes, there is. For a medical doctor, it is a professional income protection policy. Let me run through the comparison for you: money in EPF versus money into a medical professional income protection policy. Now, the fundamentals of doing such policy is that both of us know your ability to earn an income depends 100% on your ability to work. A doctor stopped working, he stopped earning. That is a fact. Now, you might be thinking, what will actually stop a doctor from working? Let me give you some example. A serious injury to a surgeon's hand, a stroke, paralysis if you're unable to stand, walk, loss of memory due to an accident, a cancer treatment that prohibits you from running the clinics, major heart attack, put you out of work for 6 months. And there are many more examples. Life is uncertain. So getting an extra layer of coverage against all these risks that may stop you from working is a great idea. So let us do the comparison between EPF versus income protection policy. This is the example based on a 35-year-old medical doctor who will work until the good age of 55 and he decides to retire, let's say 20 years, or stop contributing to EPF. Now, if you look at this, $3,750 a month, which is 23% of his income, if you put into EPF, you are putting $45,000 a year. It is the same with the income protection policy. Now, with the interest rate of 5% on EPF and the interest rate of 4.5% on the average on the income protection plan, both will yield about $1.4 million at the age of 55 when you're ready to retire. But let's look at the bottom, the insurance coverage that we provide. EPF doesn't give you anything on insurance coverage. Zero. Nothing is given. Life insurance, nothing. But the income protection plan gives you $2 million. If you die, if a person becomes paralyzed or become disabled, the policy will pay $2 million to the family. That is income protection against your future income. Total disablement, $2 million. Critical illness, the income protection policy pays $2 million of critical illness. If a person has a stroke, cancer, or a heart attack, or any unfortunate critical illness of that, we will pay $2 million straight to the doctor to pay forward your income, to make sure that if you are unable to work, you still have cash in your pocket. Accidental death, the policy pays $4 million. Accidental death due to public transport, the policy pays $6 million. And if it's death due to natural disaster, it's $12 million. So the last one, what happens after you stop contributing to this policy or to EPF? When you stop contributing to EPF, you either redraw it or let it grow by itself. But in insurance, in the income protection policy, if you stop contributing at 55, the coverage will continue until the age of 70. And at that point, you can decide to redraw or to keep the money there. So let's face it, if you are not contributing to EPF or just doing as little as you can, you need to rethink your strategy and start putting some money into an income protection policy for your family and your potential income. Now, why take the best of one side when you can enjoy the best of both worlds? Enough coverage for yourself, good returns for retirement. So I will urge you to save up 23% of your income into an income protection plan today and have peace of mind. Now, if you need some professional consultation on how to set this up, call me and WhatsApp me. I promise you that we will listen, we will discuss in private, and design a solution that will tailor to you and implement a plan that will benefit you and your family. Now, this is Insurance Matters, and this is Limran and Life. Until next week, stay safe.